All right, Paige, come on up.
Okay. That was quite an intro. Thank you. Hi, everybody. Thank you so much for coming out. As Christina said, I have been a real estate investor for over 20 years, and I've done just about everything there is to do in real estate investing. And when I came to the note space, let there be light. Sure. When I came into the note space, I will often say that angels sang for me, and I'm going to talk about that a little bit in a moment. As Christina said, I was an investor early on. I owned my own construction company. I had at one point 36 employees. We held all of our contracting licenses with the exception of HVAC and roofing. And the reason that we didn't hold those licenses is because the insurance was very expensive, okay? So 36 employees, I was in my mid-30s, and we were rocking and rolling in 2003, 2004, 2005, as if anybody remembers, the real estate market was going up, up, up. And then 2007 happened, okay? And I saw it coming. Christina didn't get the memo. I got the memo, but I didn't think it could happen to me. Here's why. I was only 10% leveraged, I had a lot of assets, and I had a lot of liquidity. And it happened to me. It happened right on my head, and it took me down. I literally spent 3 years of my life, every single day, waking up in the morning and making sure that I was going to pay all of my investors, all of my vendors, and I was going to do whatever it took within all legal means and within my power to make sure I made everybody whole that believed in me. And I did. It took me 3 years. I liquidated everything that I owned. And at the end of the day, 3 years later, I walked away with my shirt on my back, and that was it. I lost $20 million. Now, I tell you that story. I didn't used to tell that story. Understandably, right? You don't walk up and say, "Hi, I'm Paige. I lost $20 million in 2007, right? You don't. Because I had to go through my own process. And my dear friend Christina is the one that taught me to call it a very difficult learning experience. That came from her. For a long time, I wore it as a badge of shame. Until I had some conversations, until I picked myself back up, until my friend Christina said it's a very difficult learning experience. And I looked at it in a new light. And I started sharing my story. And I share it with you and with others to let you know it's just, I hate to be cavalier about this, it's just money. I had a tremendous support system around me. I had a network that was able to lift me up. I had people that I could ask questions and I could rely upon and that that supported me. And now I'm back, I'm stronger than ever, and I know who I am as an investor, okay? Here's something that's really important, especially in real estate investing. Everybody has, Christina talked about our why. We all have our why of why we want to do this. Jobs and me don't mix at all, never have. But our why is very personal. It's a very personal thing. For me, I challenge people to focus on your what, okay? There's lots of shiny objects out there in real estate investing, and if you're new, you wander around thinking, oh, well, that sounds good. Oh, well, but maybe over here, and well, maybe, and you are constantly spinning in a circle trying to figure out, where do I fit, okay? So I see some nodding heads. So find your what, and what I mean by that is, what is your risk tolerance? Do you have a little time to be able to, if you lose a little bit of money, and by the way, this happens to every single real estate investor ever. It happens. Hopefully it doesn't happen too much, like $20 million. Hopefully it only happens a little bit. But successful real estate investors are successful because they have had really difficult learning experiences. I'm going to say that again. Successful people are successful because they've had really difficult learning experiences. It shapes you. I know my risk tolerance. I don't ever want to have to go through that again, ever, okay? I want to help people that are going through it right now. I wanted to, when I first came back in, I needed to generate chunks of money and I needed to generate streams of money. So if you are in a position where you just want passive income and monthly cash flow, don't go into fix and flip. That's short term and it creates chunks of cash, right? It doesn't create streams of cash. If you need chunks of cash, don't go into buy and hold right away. That doesn't make sense. So figure out what your what is, and then pick maybe one or two things and go in that direction. And if you don't like it, if you research it, like Christina said, go for 6 months, go to meetings, do your research, and if it doesn't fit for you, then change. But don't spin yourself into a whirling dervish because you don't know and everything looks good. So develop what your what is, okay? When I said that I came into non-performing notes, excuse me one moment. Non-performing notes for me fit all of my criteria. Now, a lot of people don't know what a note is, so I'm going to go over that for you. When you buy, and there's all different kinds of notes. A note is basically a promise. It's a debt instrument. It's a promise to pay, okay? So when you sign a credit card statement, that's a note. When you sign that now it's a little pad, but when you sign that, that's a note. You're promising to pay the bank back for the money that they have fronted you to buy whatever object or objects you're buying. When you buy a car, you sign a note. I focus on notes that are secured by residential real estate, okay? We do some commercial, but the 80% of our portfolio focuses on residential, all right? I also buy non-performing, which means people aren't paying, which sounds crazy. Who thinks that sounds crazy? I did too when I first came into this space. The reason that I buy non-performing is because the banks give us a much larger discount when we buy that note. Now, when we buy the note at a much larger discount, what happens? We build in equity, okay? And I'll talk about that in a little bit. But when you build in equity, an equity cushion, that mitigates your risk, doesn't it? Because what happens, everybody's expecting, especially here in California, you know, the real estate market has gone up, 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 up. And everybody who's been around long enough knows that there's corrections. Hopefully not crashes, but corrections, okay? So when you buy a note for a substantial discount, now you've built in a cushion of equity that gives you the ability to mitigate that risk if there is a correction, if there is a drop in values, right? So that for me was very important. Very important, because again, I didn't want to be beholden to somebody, to very thin margins, where if there is a correction or a crash, that I was going to lose everything again. Didn't want that to happen, okay? So, non-performing versus performing. Performing notes are just that. You can buy notes for monthly cash flow that are performing. You're not going to get as big a discount. That's why I buy non-performing. Now, my strategy as an investor, there are investors that are out there that buy non-performing notes strictly because they want the house, okay? They want to foreclose on that house. That's not my strategy. It might be good for other people, but it's not good for me as an investor. Again, know your what. Know your what. My strategy is to help people who are qualified that has just had life happen to them. They've just had that bad thing that's, hit their credit. They lost their job. They went through a divorce. They had a medical issue. There was a death in the family. Has anybody had any of those things happen to them? Of course. Life happens every day. Does that mean that you're a bad person? No. So my partners and myself take the strategy that we're going to try and help qualified persons to get back on their feet and stay in their home and get them to reperform at a manageable level. That's who I am as an investor. That's not who everybody else is, okay? And how I do that is by buying my notes well, and I'll talk about that in a moment, and really taking a look at having that in my heart that this is somebody that I want to help that will very likely be qualified, okay? But it all generates and it all starts by buying your notes well. I will often say that there is no such thing as a bad note. There is such a thing as buying notes badly. Like anything else, if you don't do your due diligence, you could get hurt if you don't know the questions to ask. Now, let me tell you that in note investing, it's a lot of front-end loaded due diligence, more so than just about any other type of investing, okay? Once you buy the note, then it's just managing the managers. But it's having all of the knowledge ahead of time to know how to do your due diligence well so that you can mitigate your risk and prevent any kind of financial hurt and pain, okay? Again, you could go out right now, this very moment, and you can go on a website and you can find a note dealer or a note broker and you can buy a note, just like that. However, again, if you don't know the due diligence steps to take and the questions to ask, you can seriously get hurt. So I strongly advise against that. Educate yourself. There are plenty of free platforms that are out there to educate yourself and ask questions. And by the way, for those of you who are new real estate investors, when you know somebody has been in this field for a long time, usually, not all of us, but usually we're very open to questions because we didn't have it when we were coming up through the ranks. So in my philosophy, I like to pay it forward. Now, obviously, if every single one of you called me 5 times a day, I would not be able to get my business done. But, you know, be respectful, but at the same time, don't be afraid. As far as I'm concerned, there are no dumb questions at all, okay? All right, so I have my little notes up here. How can we make money buying a non-performing note? Because again, these notes are not performing. So we have several different exit strategies. Now, by the way, it's really good to be the bank. Really good to be the bank because we can generate chunks of cash, we can generate streams of cash, we can generate both, and we can generate it twice in the same transaction. Profit, lots of profit while helping people. Those are my 2 passions. Love it. You know, it fits the need for me. So, non-performing notes that gives you the positioning to be able to, if you buy it well, and we get it to reperform. Let's talk about the 4 different exit strategies that we mainly use. And by the way, there's 23 different exit strategies in non-performing notes. 23. Can you say mitigate risk? Pretty much no matter what happens in this market or in future markets, if you buy your notes well, you can ebb and flow with it. As long as you're flexible and don't put your blinders on, there's 23 different exit strategies that you have at your disposal to mitigate your risk. Who likes that? It gives you control, right? It gives you control. So even if you have an oops, and please don't have oopses, and if they are, just little ones, you know, $100, $200 oopses. But even if you do, 23 different exit strategies, we mainly use 4, okay? Our least favorite is foreclosure. Everybody knows what foreclosure is. Sometimes we have to do it, but it's our least favorite, all right? Foreclosure often will happen if the borrower is deceased and there are no heirs. So we have to do a foreclosure. Foreclosures are always, always, always via an auction. Always. Whether it's a judicial foreclosure state or a non-judicial foreclosure state, and I will explain that in a moment, there's always an auction. And it keeps banks honest. That's why they do it. The public has to have an opportunity to partake in the sale. That's the short answer of why they do it. But it's always an auction. In a judicial foreclosure state, we have to go to court and we have to ask the judge permission to foreclose on that property, okay? Some judicial foreclosure states take a very short amount of time, relatively speaking, and then some judicial foreclosure states take a very long amount of time. Now, here back again to your what. For me as an investor and my partner, and generally any investors that work with us, we want to be in and out of a note within a 12-month period of time, okay? That's good for us. So we know not to invest in certain states because we know they're judicial foreclosure states and or they take an exorbitant amount of time. New York, New Jersey, Rhode Island, we don't invest in those states. Here's why. New York is almost a 4-year foreclosure time. 4 years. Cook County, Illinois is another one that is an exorbitant amount of time. Other parts of Illinois, not so much, but Rhode Island is a non-judicial foreclosure state. However, it's very borrower-friendly. And borrowers in Rhode Island have a tendency to be very litigious. So we don't invest in Rhode Island, okay? I've often been asked the question, do you avoid states that are judicial? And my answer is no. We prefer states that are non-judicial because the non-judicial foreclosure states, the foreclosure time is a lot shorter, typically, not always. But if you're going to miss out on some opportunities, if you're in you're in a judicial foreclosure state, there might be some great notes for you to buy with some serious equity, and you're going to miss out because it's a judicial state, and you say, "Oh, I don't want to invest in judicial foreclosure states." So, know yourself, but don't create tunnel vision to the point that you're missing out on opportunities. All right. Vacant versus occupied, same thing. We would prefer, and I say we, would prefer occupied because, again, my strategy is that I want to try and help that homeowner stay in their home. So we would prefer it. Do we only look at occupied? No, absolutely not. So know your criteria and develop that into a place that is going to give you parameters. But understand that note investing does not fit in a box. You have to be flexible. You have to be flexible. You have a baseline of criteria, and then you have data points, and you move up and down with those data points, okay? All right, so we talked about foreclosure. Short sale, just about everybody knows what short sale is. If we get a note that we are owed $100,000, and we have a buyer that comes in for $80,000, we as the bank will make a decision based on our due diligence. Is that good or is that not? Now, who here has had to deal with big, large banks and short sales and trying to get a short sale pushed through? How long did it take you? 9 months. Long time. Okay, we're going to talk about pricing about these notes in a moment, but if, let's say, for instance, my big discount on that $100,000 that I'm owed, and I pay $40,000 or $45,000 for it, and we get an offer for $80,000 within a 2 or 3 month or 4 month period of time, how fast do you think I'm going to make that decision? Like that. Flexibility and control. Do I have to take that short sale? No. What if I want the house? I can try and foreclose on it, right? And if I'm owed $100,000 and it's only worth $80,000, and I price the opening bid at that auction at $100,000 because I want the house, do you think I'm probably going to get the house? Yeah. Who's seeing a pattern of control? Who likes being the bank? Exactly. All right, so short sale. Deed in lieu of foreclosure. If you don't know what a deed in lieu of foreclosure, that's another of our 4. Deed in lieu of foreclosure is just that. If we go to our borrower through our loss mitigation team and they say to us, you know what, life has happened to me and I just have bad memories of being in this house and I don't want this house anymore, but I don't want a foreclosure on my credit. Would you be willing, Mr. Bank, to take the deed? I will sign over all of my interest in this property and take the deed as payment in full. Again, if I've paid $40,000 or $45,000 for this note, collateralized by a property and secured by a property that's worth $80,000, and the homeowner is willing to, the borrower is willing to turn it over to me, how fast do you think I'm going to make that decision? The answer is it depends. I tricked you on that one. Why does it depend? It depends because if there are junior liens behind me, I only buy first position. Who's heard of a HELOC? Who's heard of a second loan behind them? Who's heard of municipal liens and tax, delinquent taxes and code enforcement? If you don't check that stuff, and you now take a deed in lieu of foreclosure, what happens? Now it's on us. It's our responsibility, right? Because we're taking the deed as payment in full for our loan. So what happens to our loan? It goes away. It's gone, right? And everybody moves up a peg. So know your due diligence steps. That's stuff that is hugely important in this space, okay? And there's different things that we don't really have time tonight to talk about, but there's definitely steps that you can take to find out all of this information, all right? So deed in lieu of foreclosure, assuming that there's no liens behind us, or if they're just minimal, as long as we know about it and have the knowledge, we can mitigate our risk by acting on it, right? So if there's enough equity, sometimes we will take that deed in lieu of foreclosure, even if there are junior liens behind us or delinquent taxes, because we know there's enough profit to be made. As long as we're aware of the juniors behind us and the numbers make sense, we still do the deal, right?
You just full title and it has everything and then you just...
Sort of. Okay, so quickly. No, that's okay. No, that's okay. I do want to definitely answer all of those questions. Briefly, it's what's called an O&E report, okay? That stands for ownership and encumbrance. It basically will give you information that is attached, any liens, anything that has been recorded, including divorces and judgments and everything else, anything that's recorded against the borrower or the property, okay? So you need to know how to read an O&E report and what to look for, because the O&E report might show who would be afraid to buy a property that showed, an O&E report showed a federal tax lien of $53,000? Who'd be afraid of that? It depends. Great answer. It depends. But if you didn't know that that federal tax lien was income tax and not attached to the property, but rather attached to the borrower, you might miss out on an opportunity, right? So you need to know your steps of doing your due diligence, but that's one way to do it, okay, the O&E report. All right, so deed in lieu of foreclosure, and then of course we get to my favorite, which is reperform, okay? Reperforming, now different investors do this different ways. I like to help homeowners and I like to give them a chance. That doesn't mean that I take off my business hat and just put my big heart on, okay? Understand that this is a business, and especially if you're dealing with other people's money, which often as real estate investors we do, because unfortunately at some point we all cap out, right, with the dollars that we have in our pocket. So if you're using other people's money, you've got to be very, very careful with your big heart, okay? Everything within reason, but keep your business, it's okay to have your heart, but keep your business hat on, all right? Reperforming, we will go through our loss mitigation team. And by the way, I love this too, because we don't deal with borrowers directly. We are not licensed debt collectors. There are certain regulations and things you can and cannot say that to a borrower that I don't want to mess up. So it's worth every penny for me to pay my loss mitigation team and my service team the $75, $80 it is per note per month for them to deal with it, right? So we don't ever deal directly with our borrowers. We have a team that does that because they're licensed to do so. So we have the communications with our borrowers through our loss mitigation. And if we find out that the borrower wants to stay in the property, then we can do any number of things. We can lengthen the term of their loan. We can reduce their interest rate. When we reduce their interest rate and lengthen the term of their loan, what happens to their mortgage payment? It goes down. Exactly. God, this is a room of smart people. So it goes down. Can we forgive debt? Yeah, absolutely. Would it behoove us to forgive debt? Yes. Here's why. That same house, that $100,000, remember the people we were talking about that had a $100,000 note. Let's say they haven't paid for 2, 3, 5 years. And there are borrowers that are out there that have not paid for 5+ years, believe it or not. So let's say they haven't paid and they've racked up another $20,000, $30,000 in arrearage. That's delinquent payments, delinquent interest, that they haven't paid. We as the bank have the right to protect our investment. So if they haven't paid property taxes, we as the bank can pay those property taxes and then be reimbursed through one, it's a recoverable expense, okay? Attorney's fees are recoverable expenses. So all of those things add up. So if they haven't paid, now they're into it for $130,000. That's the face value of the note. The property is only worth $80,000. I'm going to buy that note just for easy math. Numbers have gone up a little bit, but for easy math, I buy that note at 50%. Okay? And then there's on that $80,000, and by the way, I buy it at 50% of current market value. Please write that down if you're taking notes, because we don't ever pay 50% of the unpaid balance. Ever. Because.
What do you mean by market value?
Great question. So again, in a first position, we evaluate the collateral, which is the house that's securing our investment. So if the house is currently only worth $80,000 as it sits right now, we buy at the discount based on the current market value as it sits right now.
Not of the note of that.
Not of the note.
So the note could be $5 million.
The note could be $5 million.
$80,000 you were offered $40. So if it's
Correct.
$50,000 doesn't matter. Worth all the default interest and everything racked up.
Correct. Correct. As a matter of fact, we have a note right now that the unpaid balance, the total legal balance is $141,000. The property is only worth $50,000. The borrower is deceased. We're going to foreclosure sale, and I gave the opening bid to our attorney, local counsel, and I gave them a $37,000 bid. And he came back and he said, "You're owed $141,000. Do you know that?" Yes. I paid $14,000 for that note. You think I'm going to be happy with $37,000 if I get it? Yeah. It was 5 months ago, by the way, that I bought that note. Okay? Lots of control here, guys. Now, see, the light bulbs are going on. All right, so tips. So, getting back to the reperforming situation, and how do we help people? Okay, so now this person is in debt $130,000. Their house is only worth $80,000. I have paid $40,000 for this note, so I have a lot of flexibility, don't I? Can I go to my borrower and say, "Mr. Borrower, can you afford, let's say their payment is $840 a month. Can you afford $700 a month?" Yes. Can you afford, let's take your interest rate down from 8% or 9% or 12% in some of these cases, and let's bring it down to something that's more reasonable, 6.5%, 7%. Am I going to be happy with 6 or 7% right now? Yeah. Let's extend the length of the loan, 40 years. Can we do that? Who'd like to cash flow for 40 years? Right. Smart people in this room, I'm telling you. Okay, so here's how we make that happen. Because this borrower hasn't been paying, right? So what are we going to do to incentivize them to pay us? Go. Debt forgiveness. Debt forgiveness. No, so that's great. Could we say to them, tell you what, Mr. Borrower, why don't we, of that $50,000 that you're in arrears, because the house is only worth, $30,000. We were in arrears, $30,000. Why don't we take 50% of that if you make your payments on time, every time for the first 4 to 6 months? We'll take that $30,000 and we'll slash it in half. Do you think they'd be motivated? Yeah. And then we'll say, let's take the next, if you pay the next 4 to 6 months on time every time, we'll cut out the other 50%. Now they're really motivated, okay? We also, and that's within our purview, that's within our power. We can do that. That's how we help them. We also do not go, I as an investor, do not go directly into a loan modification. Here's why. Because if the borrower has already defaulted, they may do it again, right? So do I want to wipe out all that debt if they make 1 or 2 payments? No. I don't ever give up my rights until they have a consistent pattern. So we put in place what's called a forbearance agreement, which means they promise to do something, we promise to do something. And until both of those promises have been fulfilled, then a modification, a permanent modification is put in place and recorded, okay? That lets me keep my rights to make sure that that borrower performs. Okay, now, we also, will ask for what we call a reinstatement fee. Generally, it's anywhere between $3,500 and $7,500 in the price points we're talking about. Now, you might say to me, well, the borrower hasn't paid. How on earth are they going to come up with, $3,000 or $7,000? People that want to stay in their home will find a way to come up with $3,500 to $7,500. Trust me on this. And if not, they could come back to us and say, you know what, I can come up with $3,500 right now, and then I can do payments of X amount of dollars over the course of the next 3 or 4 months, in addition to the monthly payment. Would that be okay? Who would like that? Did we generate a chunk of cash? Yes. Do we generate streams of cash? Okay, so now we're cash flowing it through 12 months. The borrower has performed, has reperformed. We've now put in a permanent modification in place. Do we have to stay with it and sell? Do we have to stay and cash flow that loan? No, we can sell it. We've now seasoned the note. It's called seasoning the note. We've got a track record anywhere from 8 to 12 months. We've generated a chunk of cash. We've generated streams of cash. And at the end of 12 months, if we want to exit the note, we can sell it to another note investor, or we can help that borrower refinance. There used to be a program called FHA 1023. It is no longer, it has been replaced. Please don't ask me the number because I don't remember it. Sorry. But FHA 1023 said, we, the government, will come in and help because you, Mr. Bank, have helped this borrower to get back on their feet. We will come in and refinance that loan out at 97.5% of the current market value. So if we've got a current market value of $80,000, they're going to pay $78,000 and change. Who's happy with that deal? Right? In 12 months or less. Can you see why I like note investing? Can you see why I like helping borrowers to reperform? They get to stay in their house. We've brought their mortgage down to a manageable level. Their kids get to stay in the same school, and we make a bunch of money doing it. Right? I saw a question? No? Okay. How are we doing on time? Are we okay? Okay. Yeah.
Out of all the notes you buy, how many of them actually turn out like that?
That's a great question. Thank you. Thank you for asking me that.
It sounds great.
So the question is, out of all the notes that we buy, how many actually turn out in a reperforming situation? Believe it or not, out of every 10 notes, a third. So a third will end up in a foreclosure situation, a third will end up in either short sale or deed in lieu, and a third will end up as a reperformer.
Make money on all of them, right?
On all of them. We anticipate when we do our analysis, because again, there's an unknown factor. Understand, this is not a house that you can go and look, especially if the borrower's in there. We can't walk up to the house and say, hey, can I see the inside of the house because I think I'm going to become your new bank. So there's an unknown factor there. And we have to anticipate that, which is why we buy at such a big discount, because the banks that are selling to us know that there is an element of the unknown. Yes?
So, do you buy directly from banks, or do you always go through a broker?
Another
If I
great
wanted to
question.
buy a bunch of notes.
Yes, yes, and yes. Okay, so I collectively call the people that we buy from asset managers. We buy from banks, and by the way, please don't walk into Wells Fargo and say, I know that this house is on your foreclosure list and I want to buy the note. They're going to say, huh? No. To buy from Wells Fargo, you literally have to have hundreds of millions of dollars, and you can't just buy one, okay? But we do buy from smaller regional banks, okay? We buy from hedge funds, big and small. We buy from note brokers. We buy from other note investors. We buy from anybody who's got a note that the numbers make sense. Yes?
All over the country you buy them?
All over the country. Now again, for those that are new, I'll get right to you. For those that are new and don't have the buying capabilities of 10, 15, 25, 50, 100 notes a month, you need to be specific in terms of market. Choose a few markets that you want to invest in. Don't be too general, but yeah, we buy all across the country that fit our criteria. Now here's another quick thing. We don't buy in counties that don't have a population of at least 50,000 people. Why? Resale. If we end up with a house as REO, we want to know that there's a pool of people that we can sell it to, right? Network, by the way, everybody, especially on Bigger Pockets. Who's heard of Bigger Pockets? Okay, if you're not on Bigger Pockets, please get on Bigger Pockets. It's free. And it's all across the country. And your net worth is based on your network. I'm sure everybody's heard of that. It's so true, especially in this space. Because you need to offload the assets that you want to offload if you want to get your capital back out. I told the gentleman in the back that I would go to him, and then I'll come to you, Matt.
How do you mitigate the risk of bankruptcy? That's the nightmare.
Bankruptcy. Love that question. We love bankruptcy. Love bankruptcy. I'm not kidding. Note investors absolutely love bankruptcy. The reason is bankruptcy 7. We are in the first position secured, right? That's what I buy. I don't buy seconds. There are very successful second note investors. I've been through 2007. I do not want to willingly go into an investment where I know that 50% of the time I'm going to lose my money to a foreclosing first. That's just me, okay? So bankruptcy, in a first position, we have a secured debt. The house is the collateral. So in bankruptcy 13, we love it because now there's a federal trustee that is watching over and running the show and making our borrower reperform. So we do our reperformance forbearance agreement through the bankruptcy court. And if the borrower defaults, then we go to that trustee and to the judge and we say, you know what? This was their plan. We agreed to their plan, and now they're defaulting. You need to relieve us from the stay. You need to lift the stay. And the judge will do it. And, if they do continue, then now we're collecting monthly payments that's regulated by the federal trustee. So we love bankruptcy 13. Bankruptcy 7, that's okay too. Here's why. The federal judge says, Okay, Mr. Borrower, you can't pay for the house, so you can't stay in the house, right? So they will relieve the borrower of the debt obligation and relieve the stay, lift the stay, and give us the opportunity to foreclose. Okay?
But doesn't it, if you bought the note and then they filed a BK to protect themselves
Mm-hmm.
from having to pay you, doesn't it severely change your cash flow strategy because they can delay this 2-3 years before they start to have to pay?
Yes, there is some element of that. Generally, the bankruptcy court won't allow a plan to take 2 or 3 years to get into place. So what happens is the borrower has to come up with a plan that is confirmed through the court with all of us, everybody that is owed, especially the secured creditors that are owed. We have to approve the plan as well. So we do have a say in that, but generally the court does not want, the court dockets, as everybody knows, are full. So they don't want anything happening 2, 3, 4 years down the line just before there's a plan in place.
You were talking about the deeds and the liens.
Oh, sorry.
But you also have liens on the foreclosures and short sales, potential of those on the note?
The deeds and the liens in terms of, okay, yes. I think I understand the question. So,
There could be a first, second, third, or
yes.
lien on all those also, correct?
Yes. Okay, great question. So, yes. So if we have to go to foreclosure and there are liens that are behind us, tax liens or any kind of judgments or anything like that, what happens there? Okay, so what happens is municipal liens, meaning property taxes, code enforcement, sewer. Here's another little tidbit. Know if the county controls the water and sewer. Because if the county controls the water and the sewer on the note and the borrower has not paid their water or their sewer bill, you need to be aware of it because you can be on the hook for it, right? And sometimes I've literally seen $2,000 or $3,000 in sewer and water bills that have been unpaid that I thought, oh, well, that's going to be wiped out by the foreclosure. No, that's an oops, by the way. Not a bad one, but it's an oops. Okay, so you need to know about those things. So what will happen is municipal liens will not be wiped out by a foreclosure. So you do need to know about them. You will be responsible for them if you end up with the property as REO. If you don't end up with the property and it sells to third party at foreclosure auction, they're on the hook. Okay, seconds will be wiped out. Generally, like credit card judgments and things like that will be wiped out, but anything county or municipalities, they will not be wiped out by foreclosure.
And that's
Okay.
on the O&E report?
Ah, not always. Trust but verify. Trust but verify.
So where would it be you call water, the county and water and sewer?
Every single one. And by the way, a lot of the delinquent taxes, a lot of the counties will have their taxes, the property taxes that are due and owing on their website. Trust but verify, please, because they're not always up to date. They're not always up to date. There are some that you can't do anything but use the website, and you can pay for it, but I don't suggest that unless you have an actual agreed upon price with the asset manager. So,
how do you determine current market value?
smart people in this room. Current market value. Okay, like anything else. Do we use Zillow to create our values? No. But Zillow does have a whole lot of information. Don't ever use Zillow, please. Please don't ever use Zillow. One good site I will tell you is called iComps, icomps.com. They're actually pretty good. Not always, but for the most part, for an online service, icomps.com is pretty good. Strictly because they give you all of the different comps in the area, and they actually map it. So on the left side of the screen, you actually see the address, the beds and baths, the square footages, the date it sold, and how far it is away from your property. So that's a good one. But what we do is we do a desktop analysis, of course, and any real estate investor, should have some nugget of knowledge of how to do that. If not, then please find out. Please ask questions, okay? But what we do is once we have an accepted offer, meaning we've offered to the bank or the asset manager to buy that note, once we have an accepted offer, we now call a local realtor with boots on the ground. Do we ever rely on Google Earth to see the pictures of the property? No, we don't. I actually know of somebody that saw a Google Earth that was 2 months old, and they bought it sight unseen. They bought the note sight unseen, and there was a fire in the house. The fire totaled the house. Gone. What happened to his investment? Gone. Always boots on the ground. Always, I don't care if it's a friend, somebody on Bigger Pockets, call a realtor, and don't lie to realtors, please. Please don't lie to realtors. Explain what you're doing. Don't make promises that you can't keep. So here's how this conversation goes. Hi, Matt. My name is Paige. I'm calling from California. I'm a note investor. I buy across the country, and I need to know, I'm hoping I can take a few minutes of your valuable time. Valuable time, acknowledge. This is their time. You're asking them to do you a favor, okay? I am a note investor. We have not bought this note yet, but this is a property that is collateralizing the note I'm looking to buy. Oftentimes we end up in an REO situation, in a foreclosed situation, and we end up with the property. If you take a few minutes of your time right now, I would love to talk to you in a short period of time or a long period of time, depending upon what state it's in, judicial versus non-judicial. We'd like to talk to you about listing it if we end up with the property back. I didn't lie. I also didn't promise you. Did you notice that? I didn't promise Matt the listing. I said we would talk about it. Because I don't know what your fees are, what your commission base is. I don't know how good you are. You're good, yeah. But at least, and then honor that. And then honor it. So if you end up with the property, and let them know. My team lets our realtors know. Hey, thanks so much. We were in contact a month ago. Here's what's happening. They appreciate that. And then when we call them again, because we buy across the country, when we call them again, they're going to be willing to go out and do it for us again, right? There are some realtors I've been known to send, just because they went above and beyond. We didn't even buy the note, but because they went above and beyond, I bought them a Starbucks gift card and sent it to them, just as a thank you. You know, people, you guys, people, especially if you're asking them to do you favors. So, boots on the ground, we ask them for a CMA, and we ask them for pictures. Okay? Great question. Sorry, hold on one second. Comparative market analysis.
How do you factor in the fact with not being able to go into the house, that could create a pretty big difference in the value?
Yes. Okay, so the question is, how do you factor in the inside of the house might be totally trashed? Again, that's why we buy it at a very big discount. Generally speaking, especially when we're talking to professional realtors, when you roll up to a house and you see tires in the front yard and you see a bunch of crap on the side of the house, you can pretty much gauge what the inside of the house is going to look like, right? So you take that into account. Very rarely are we surprised. Very rarely are we surprised. Oh my goodness, okay.
Yeah, I was just wondering, do you have like an in-house attorney or defendant specialized in this kind of field?
Great question. Okay, so yes, our loss mitigation team, here, this is important. Loss mitigation, you want to make sure that they are licensed in the states that you are buying your notes. Our loss mitigation team is in all 50 states. They are licensed attorneys in 5 states. They liaison and have other connections with other attorneys, and that's part of their role, is that they're our liaison between local counsel and us, okay?
When you do your CMA, do you have like a checklist for comps, for example, like has to have been sold in X amount of months previously, certain amount of distance away, etc., or do you just have like an overall market analysis and then decide yourself?
Another great question, Brett. Okay, so the question is, do we have a checklist in terms of our CMA and the things that we're looking for? When we deal with professional realtors, now this is something that's going to be very indicative to you if you know to ask the questions. If a realtor gives you a totally just cash only, sold as is, junky house, and then they give you a comp in that same CMA for a fully brand new spanky rehabbed ARV way out the roof house, how professional do you think that realtor is, or how much time do you think they spent? Not much. Are you going to rely on that CMA? No. Do you call another realtor? Yes. Now, if the first realtor provided you pictures, please don't ask the second realtor for pictures. You can call them and say, you know what, I talked to a realtor, and unfortunately they gave me a CMA that has, you know, an as-is house with a fully rehabbed house, and I just need a little help here because I'm in California. People want to help me because I'm in California. Tell them that, right? Tell them that. Be honest. And then start talking, you know, especially if it's snowing. They love talking about how wonderful the weather is in California. And then you could throw a little nugget. Yeah, if you ever come out, I'm happy to take you to coffee. I mean, truthfully. Yeah.
So how difficult is it to find notes? Because aren't most of them sold like in big groups?
Smart people in this room. Okay, Nancy, yes. How difficult is it to find notes? The answer is sometimes not so difficult. The answer is sometimes very difficult, right? There is not, Christina was talking earlier with Brett and a few others about some of the rehab or the fix and flip properties that are here in California, and they're crazy, you know, $300,000 over asking price and a few other things. In the note world, there is competition, but it's very reserved. I call it the gentler way of investing because we backdoor invest, right? We don't have to submit a ton of offers. You know, we submit an offer, and if you do what you say you're going to do, and I really want to stress this, if you do what you say you're going to do, the asset managers are going to bring you better deals. They're going to fight for you in terms of the price, and they're going to bring you off-market stuff that they're not showing to anybody else, okay? So developing the relationships takes work. Like anything, there's two things in real estate investing that people look for: deals and money, right? So knowing where to go. There are some note subgroups that are starting up. Bigger Pockets has a huge forum for note investors. Go to note conferences. There's one coming up in Orange County. It's called Noteworthy, the Note Investor Summit. So that one's coming up in the beginning of April. There's the Paper Source Convention, which is perfect, by the way, for new note investors because there's asset managers there, there are servicing companies there, there's other note investors there. It's a great networking opportunity, and it's perfect. The information in the speakers is perfect, and there's no selling from the stage. It's called Paper Source. That's in Vegas. It's coming up the end of April. So go to those places. Here's another fascinating thing about note investing. When you start cultivating the relationships with your asset managers, as you grow, they will introduce you to other asset managers. Like, who does that? It happens here in this space. They will introduce you because they know that if you have a friend that you bring into this space that might be a smaller investor, one or two, it's called cherry picking, to answer your question, Nancy. There are some asset managers that you have to buy the pool, and then there's some asset managers that you can cherry pick, and then there's some that do both, okay? But they will introduce you to other asset managers because they know if you bring a friend in, you're gonna introduce that friend to them.
The asset manager referring to, the ones you were referring to earlier, are the ones that, from whom you buy the
Yes.
notes, whether it's the bank or the hedge funds or?
Yes, so again, remember I use that word as kind of a blanket. Asset manager could mean a bank, it could mean a hedge fund, it could mean a broker, it could mean another note investor. So I just kind of use it because otherwise it's going to be confusing.
Do you find that you buy any or a lot of notes in California?
That is a fantastic question. Know your what? Know your what? The answer is, actually California is non-judicial, so it's a trustee that conducts it. I do not buy notes in California. Here's why. Because the same note that's going to cost me $200,000 or $300,000 for one note, I can buy 4, 5, 6, 7, 8 notes in different states, in different markets, in different economic climates, and now what have I done? Spread the risk. Spread the risk. So now I've got 5, 6, 7, 8 baskets. So if one is kind of but the others are kind of yes, right? Now I've mitigated my risk. For me as an investor, that's hugely important. Do you see the control?
What states do you prefer then?
What states do I prefer? All of them that there's a deal that I don't have to wait more than 12 months. Ah, you know of hardest hit funds. Okay, who doesn't know what hardest hit funds are? Okay, great. The answer is yes. Hardest hit funds really came about in 2008, 2009, when all of the banks had a huge surplus of foreclosures, right? And the banks are saying, well, why should I discount and get, and modify these loans when I'm due this much money? There's nothing in it for me. So the government came up with a program for some states that were hardest hit, and they subsidized a very large amount of money per state to incentivize the banks to work with their borrowers. Some states were matched dollar for dollar for the amount of debt they forgave. Who likes that? So, some states were 25 cents on the dollar, some states were only 18 months worth of payments. It just really depended on the state. The states very quickly ran out of money, and some have gone 3 rounds already and do have some funds. So, yes, hardest hit funds, not as we don't have as much now as we did back then, but yes, we still do have some success, and that does take some time. All right, let's see. Okay, here's the other beauty of notes that I love. Again, we can create monthly cash flow passively. If you have a buy and hold property, which by the way I do love, don't get me wrong, in the large size, not so much the single families, but if you have a buy and hold property and the air conditioning goes out and you're the landlord, who does your tenant call? You. If you're the bank and you've worked with this borrower to reperform and keep them in their home and their air conditioning goes out, are they going to call you? No. You're not going to get the midnight phone call. I have a fellow real estate investor today that called me and she says, I have to drive up to Bakersfield because the septic tank overflowed into the house. Ew. I don't have to deal with that. Here's another nugget. We are the first to get paid if there's a catastrophe. Why is that? We put insurance in place. We, as the bank, have the right to protect our invested funds, right? So we have the right to force place that insurance policy, and if there's a fire, or if there's a flood, or if there's a hurricane or a tornado, and it picks up that house and trashes it, who gets paid? Me. Do I have a deductible? No. Okay? Yes, ma'am.
Is there such a thing as a bad?
I think I touched on it a little bit, but a great question. Is there such a thing as a bad note? No, there is not such a thing, in my opinion, as a bad note. There is buying a note badly. If you don't do your due diligence, if you don't check for liens, if you don't call the county, if you only rely on Google Earth to see the picture of the house, if you, what's another one? Crime rates. Do we want to know what crime rates are? Yes, why? Because nobody wants to buy a house in a war zone, right? So for me as an investor, I'm not going to buy notes that are secured by properties in war zones. I'm not going to do it. I also don't buy anything that has less than 2 bedrooms. I don't buy anything that's less than 800 square feet. So these are all my due diligence steps. So if I don't do this, if I don't take precautions to protect my investment, and if I don't stick to who I am as an investor and stick to my criteria, and I go outside those lines, could I buy a note badly? Yes. Can I get hurt? Yes. So I urge you, make sure that you know who you are as an investor and what is important to you, because it's different for every single one of us. And stick to it. Don't make a deal happen, because especially in the note world, believe me when I tell you, you can create a deal that isn't a deal. All you have to do is manipulate the numbers and convince yourself. Don't do it. Don't do it. Okay? We have only a couple minutes left, so I think let's take a few more questions. Is there?
I think you said something about holding your notes for 12 months. Is that what you prefer? Is that what you said?
Yes, I prefer to hold my notes for 12 months or less.
So then do you hold any for long term?
Yes. Okay, so do I hold any notes for long term? Yes. And again, this differs by every different person. So when I came into the note space, as you can imagine, after I came back from having the crushing blow of losing $20 million, I had to build up my funds, right? Because I couldn't create money out of thin air. So what I did is I got them to reperform. I sold them to another note investor. I generated a chunk of cash, and now I put it into 2 notes. And then I did that again. And then I did that again. And the 4th time, I held 1 back. I got it to reperform, and I held it back in a cash flow. So for us, as a strategy, typically, we will, out of every 5 notes that we get to reperform, we hold either 1 or 2. Okay? But I had to build myself up to that.
Do you do any partials on that?
Partials. Yes, we have done partials in the past. It's not one of our biggest strategies. Basically, a partial, as everybody knows, people that go into and put a mortgage in place, the first how many years is all interest? Not all, but mostly interest, right? So as a partial, what that is, and I don't want to go deep here, but as a partial, you can sell a block of those payments to another note investor that just wants just monthly payments in the short term, but you hold on to the ownership of the note on the back end, okay? So yes, we do that. You forgot.
How many notes do you look at before you usually pull the trigger? Like 20, 100, 200, before?
Great question. The answer is it depends. You'll hear me say that a lot, because again, this is not a fit in the box. It depends on what our asset managers bring to us. Sometimes I get 7, 8, 10 tapes. A tape is basically an Excel spreadsheet of all the assets that are available for sale. It's a fancy word for Excel spreadsheet. It gives you a bunch of information. So sometimes we get up to 10, 15 tapes in a month. Sometimes we get 2. Sometimes we get 500 assets on a tape, and sometimes we get 20 assets on a tape. So again, how we filter that is based on our preset criteria. So know what your preset criteria is, okay? Beds, bath.
Like maybe 5 of them might work out as far as criteria?
It depends. It depends. I just got a tape of 22 contract for deeds, which is another form of a note where you retain title ownership to the property. I'll get to you in 1 second. Where you retain title ownership to the property. It's kind of like a rent-to-own situation. You put a borrower in there, and they pay you, and when it's done, then they get the deed, okay? But we had a tape of 22. I took down 18, okay? Yes, I think last question, right?
So if I understand it
We'll
right,
get yours.
what you just said, we don't need
No. Typically, no. Especially for those in the room, again, it depends on the asset manager you're dealing with. But yes, you can cherry pick. You can cherry pick 1 or 2 notes if you've got the finances for it. And by the way, there is no financing for notes. You must pay cash. And in this space, believe me when I tell you, the asset managers all know each other. So you cannot kick tires. You can't put in an offer that you're going to purchase. They're going to hold on to that offer and that asset for you, and then you change your mind for no good reason. Don't do it. You'll get that twice, and then you won't ever get another tape ever again. Okay? If you try and wholesale a note, you'll never get another tape. Ever. Don't do it. Okay? You had the last.
What's your average buy when you're doing logo notes?
Great question. Okay, so again, our threshold, know your what. We generally buy residential real estate 1 to 4, and we go up to $200,000 in value, current market value of the property. So back it out from there. We generally don't touch anything less than $50,000 in value. So we're between $50,000 and $200,000, and generally it's running right now about 55 to 62, 63 cents on the dollar, depending upon the asset manager. And we've had some great success. But again, if the numbers don't make sense, then don't do the deal.
Now, what is the threshold to buy? $1 million? I mean, how much are you buying at a time?
It depends on where our capital is and where we've turned notes. Sometimes we have generally. Right now, I generally have anywhere between $500,000 and $1 million every month to deploy, but I had to build up to that. I didn't start out with that. I started out with $100,000 or $150,000, and that was other people's money, by the way. We joint ventured.
What's your expected return? I guess that's the only thing.
Ooh, I was wondering when someone was going to come up with that question. All right, this is a loaded question, and we're videotaping this. I have been known once a quarter to hit a home run. And what I call a home run is I generally will pick a note somewhere along the line, I've been very blessed, where I will have a return that comes in anywhere between 90 and 100% on my money. Does that happen all the time? No. Do we consistently have better returns than a hard money lender? Meaning consistently, typically over 10 or 12%? Yes. And I've also, by the way, never lost money on a note. I've been doing this 4 years. Never. Shadow inventory, really super quick, because everybody's hearing, shadow inventory, is it there, is it not there, the economy is on the mend. I just looked through at the end of 2017, and the amount of bad debt that came into the books in 2017 was almost $400 billion.
Total debt or
just 2017. No. Bad debt in. No, not credit card debt. I'm talking about real estate debt. Total real estate debt. Correct. Total real estate debt. $400 billion, just shy of, in 2017. Now, Fannie and Freddie are sitting on inventory all the way back, and they're dripping it out between $6 and $8 billion a year. So do the math. They're going to be around for a long time. Does life happen to everybody every single day? Yes. Yes. So I predict that there's going to be a lot of longevity in this market as long as you do your due diligence well and you buy properly. So I think that's it. She's boot me off the stage.